Cambridge International AS Level Business Studies Unit 1 Chapter 4 Business Objectives. Chapter 4 Business Objectives. Chapter 4 Business Objectives. Business objectives: what the business is trying to achieve or work towards. Importance of objectives: help business focus, give a clear idea of what they are trying to achieve, avoid disagreements, unite workforce, less time wasted can run the business effectively. Effective business objectives should be smart, specific to what the business does, measurable quantitative targets, more effective, achievable. Giving impossible targets will be pointless. Realistic and relevant should be realistic when compared to the resources. Time specific as limit should be set. Hierarchy of objectives: aim, mission, corporate objectives, divisional objectives, departmental objectives, individual targets. Corporate aims: long-term goals that a business hopes to achieve, core central purpose of a business activity, long-term vision for the business, benefits of establishing corporate aims, starting point for the entire set of objectives, help develop a sense of purpose and direction, allow assessment to be made later, how successful has the business been, provide the framework within which strategies and plans for business can be made. Mission statement: a statement of the business core aims phrased in a way to motivate employees and to stimulate interest by outside groups, help establish what the business is about, increasing trend to express corporate aim in one short, sharp, like statement aimed at stakeholders of the business, not concerned with specific quantifiable goals, aims of a business in motivating and appealing way. British Telecom to be the most successful worldwide telecommunications group, Google to organize the world's information and make it universally accessible and useful, Microsoft to enable people and businesses throughout the world to realize their full potential. Mission statements evaluation: quickly inform groups outside the business what the aims are and means are, motivating to employees, help guide and direct individual employees' behavior at work, moral statements or values. However, too vague, general end up saying little about business, based on public relations exercise to make stakeholders feel good, virtually impossible to analyze or disagree, woolly and general, often two different businesses end up having similar mission statements. Corporate objectives: central aim or mission statement of the business lacks specific detail and is not expressed in quantitative terms. Therefore, corporate objectives are based on central aim or mission statement but are expressed in terms that provide a much clearer guidance for management, action or strategy. Common corporate objectives: profit maximization, profit satisficing, growth, increasing market share, survival, corporate social responsibility (CSR), maximizing short-term sales revenue, and maximizing shareholder value. One, profit maximization, main objective of all stakeholders seeking reward, needed for rewarding investors and financing growth of the business. Limitations: focus on high short-term profits may jeopardize the long-term survival of the business. A business might focus more on increasing sales to get a greater market share and not maximize profits. To some owners, leisure time and retaining ownership or control is more important than making higher profits. Corporate objectives limitations: most business analysts use return on capital employed, the return on the investment rather than total profits. Other concerns need to take into account that yield lower profits, for example, the environmental impact, difficult to assess if it is has been achieved. Constant attempts in changing the price or output may lead to negative consumer reaction. 2. Profit satisficing, aiming to make a sufficient profits to keep owners happy and not aiming to work towards as much profits as possible. Common amongst owners of small businesses who prefer to live comfortably and do not wish to work longer hours for greater profits. They only aim to achieve satisfactory levels of profit. 3. Growth, usually measurable in terms of sales or value of output. Many benefits. Larger firms less likely to be taken over, enjoy economies of scale, managers are motivated because they will get higher salaries and fringe benefits. Those businesses that do not see growth become less competitive and eventually become less attractive to new investors. Limitations: rapid expansion can lead to cash flow problems. Sales growth may be achieved at the expense of lower profit margins. Large businesses can experience diseconomies of scale. Poor communication, lack of coordination may lead to lower returns to shareholders in case of companies in the short run. Growth into business areas that are away from core activities may result in a lack of focus and direction. Increasing market share closely linked to overall growth of the business. High market share, being the brand leader, leads to retailers being keen to stock the business's best-selling products. Profit margins offered to retailers may be low as they are keen to stock it, leaving more profit for the producer. Effective promotional campaigns since consumers have more confidence in the product. 5. Survival, key objectives of most new businesses, startups. Because of high rate of failure of new businesses or entrepreneurs. Once the business has established, then other long-term objectives can be set. 6. Corporate social responsibility, CSR. Corporate social responsibility. This concept applies to those businesses that consider the interests of society by taking responsibility for the impact of their decisions and activities on customers, employees, communities, and the environment. There has increasingly been a general agreement that businesses must adopt a wider perspective when setting objectives rather than just aiming for profit or expansion. One reason for this is adverse publicity given to the business because of its activities that are considered damaging to stakeholder groups and the wider world. Influential pressure groups are focusing businesses to reconsider their approach to decision-making. For example, firms can no longer pay low wages, avoid legal responsibility for their products in order to avoid conflicts with law or bad publicity. 7. Maximizing short-term sales revenue could benefit staff or managers if salaries and bonuses are dependent on sales revenue. However, if increased sales are achieved through price reductions, the actual profits of the business might fall. 8. Maximizing shareholder revenue could apply to public limited companies where management action will be directed towards increasing company share price and dividends paid to shareholders. Might be achieved by profit maximization, however this puts the interests of shareholders above those of other stakeholders. Relationship between mission, objective, and strategy and tactics. Aims and objectives provide the basis and focus for strategies. Strategies are long-term plans of action to achieve aims. With clear objectives, decision-making will lack direction and means of assessing success. Objectives and decision-making. A decision-making framework set objectives, assess the problem or situation, gather data about the problem and possible solutions, consider all decision options, make the strategic decision plan and implement the decision, review its success against the original objectives. 1. Set objectives SMART. 2. Assess and clarify problems. 3. Gather data to analyze problem. 4. Consider ideas and options. 5. Use appropriate tools. to decide between opinions. 6. Plan and implement decision action. 7. Control and review against objectives. And then again, internal constraints, for example, finance. External constraints, law, economy, competitive. Factors that determine the corporate objectives of a business. Corporate culture, size and legal form, public or private sector, number of years that business has been operating, divisional, departmental, individual objectives. Management by objectives. A method of coordinating and motivating all staff in an organization by dividing its overall aim into specific targets for each department, manager, and employee. Management by objectives (MBO) review organizational objectives, set employee objectives, monitor, evaluate, reward, and repeat. The hierarchy of objectives. Objectives in action. Aim to maximize shareholder value. Corporate objectives to increase profits of all divisions by 10% per year. Divisional objectives within one region to increase market share by 10% and cut overheads by 5%. For example, marketing increase profit margins by 7%, finance reduce long-term borrowing by 5%, R&D develop one innovative product each year. Individual targets, for example, in marketing department, increase sales by an average of 5% per client, introduce 5 more clients to the business each year. Does MBO work? Employees and managers achieving more, employees seeing the overall plan, creating shared employee responsibility, managers more easily staying in touch with employees' progress. Ethical influences on business objectives and decisions. Ethical code of conduct, a document detailing a company's rules and guidelines on staff behavior that must be followed by all employees. Decisions, ethical or moral dimensions, for example, banks, legal controls, bribes, advertisements, etc. Evaluating ethical decisions short-term versus long-term. Short-term expensive, adds to business costs, ethical or fair trade suppliers, failure to secure significant contracts or sales, advertising reduce pester power, lost sales, no price fixing with competitors, low profits, paying fair wages. Long-term substantial benefits: avoid potentially expensive court cases, ethical policies, good publicity, increased sales, increased number of ethical consumers (CSR), more likely to be awarded government contracts, well-qualified staff. Don't forget to subscribe and hit the notification bell, new videos every day.